Welcome back to your daily dose of the Singapore market, straight from your favorite investing iguana. It's 30th October 2025, and while the market seems to be finding its footing, there's a lot happening under the surface. As a content creator with a focus on global economics and a lecturer in project management, I've learned to spot the patterns behind the numbers. Today, let's peel back the layers and see what's really moving our market. The Straits Times Index, STI, kicked off the day with a modest 0.2% climb. Big names like OCBC Bank and Keppel led the charge, both up over 1%, with DBS not far behind. However, it wasn't all sunshine. Mapletree Industrial Trust took a hit, dropping more than 3%. It's a mixed bag out there, which means it's time to be selective. Keppel continues its transformation story, reporting a 5% rise in net profit for the first 9 months of the year. This figure is slightly misleading, as it includes an accounting loss from the strategic sale of its M1 telco business. If you strip out that one-time event and other discontinued operations, Keppel's core net profit from its main business arms, like infrastructure, fund management, and urban development, actually surged by an impressive 25%. Iggy's take. This is a perfect example of why you need to read beyond the headlines. The sale of M1 is part of Keppel's long-term plan to become a leaner, asset-light global manager. The real story here is the powerful 25% growth in their core engine. It tells us that their focus on sustainable infrastructure and fund management is not just talk. It's generating real, substantial profits. This move simplifies their business and unlocks value. Don't get spooked by the accounting loss. Focus on the underlying strength, which is roaring ahead. OCBC's insurance giant, Great Eastern, delivered a fantastic third quarter. Net profits soared 36% to $372 million compared to the same period last year. This impressive result was primarily fueled by strong performance from its investment portfolio, which was nicely supported by steady, modest growth in its fundamental insurance business. Iggy's take. What does this tell us? In a higher interest rate environment, a well-run insurer like Great Eastern can really shine. Their investment income gets a healthy boost, which flows directly to the bottom line. This shows smart treasury management. For investors, Great Eastern represents a defensive play that can actually thrive when other sectors feel the pressure from higher rates. It's a sign of a resilient business model and a solid balance sheet. Mapletree Industrial Trust, MIT, reported a distribution per unit, DPU, of $0.0318 for its second quarter, down 5.6% from the previous year. A big reason for this drop was the absence of a $16.3 million net gain from the divestment of its Tanglin Hall cluster, which boosted last year's payout. On the operations side, revenue for the quarter fell 6.2% to $170.2 million, and net property income declined 7.8%. Iggy's take. This is what I call a year-on-year comparison trap. The lower DPU looks bad at first glance, but it's largely because last year's numbers were inflated by a one-off sale. However, we can't ignore the dip in core revenue and property income. The key question for investors is why this happened. Is it lower occupancy in their data centers or high-tech buildings, or are they facing pressure to lower rents? You'll want to dig into their full report to check the portfolio occupancy rates and rental reversion figures to see if this is a temporary blip or a developing trend. A serious governance issue has surfaced for Leong Asia. A director at its 48.7% owned subsidiary, China Yuchai International, has resigned. This comes as he faces an investigation by authorities in China for serious violations of discipline and law, a phrase that often points to corruption probes. The news broke after Wednesday's market close. Iggy's take, red flag alert. Governance risk, especially in China, is no small matter. Even though the investigation is at a subsidiary, the close link to Leong Asia creates major uncertainty. This is a classic key man risk scenario that can shake investor confidence. The market hasn't fully reacted yet, but this is a situation to monitor closely. How Leong Asia's management communicates and handles this will be critical. Any hint of deeper issues could have a significant impact. Capitaland China Trust, CLCT, which focuses on a portfolio of properties in China, is clearly feeling the effects of the country's economic slowdown. The REIT posted an 8.5% year-on-year drop in net property income for its third quarter, which came in at 273.5 million yuan. Gross revenue also fell by 8% to 416.6 million yuan, reflecting the challenging operating environment. Iggy's take. This result isn't a shocker if you've been following the news about China's struggling consumer and property sectors. CLCT's portfolio of retail malls is on the front line, directly exposed to cautious consumer spending. The key for investors is to look deeper into their portfolio. How are their new economy assets, like logistics parks, performing compared to their retail malls? Is the weakness concentrated in one area? This is a stress test of their strategy, and it highlights the risks of single-country concentration. In a sea of volatility, Starhill Global REIT is a beacon of stability. The REIT reported a marginal 0.2% rise in net property income to $37.9 million for its first quarter. This resilience was driven by the strong performance of its prime Singapore retail properties, like its stakes in Wisma Atria and Ngee City on Orchard Road, and its assets in Malaysia. Revenue also saw a slight uptick of 0.7%. Iggy's take. Sometimes boring is beautiful. Starhill Global proves the timeless real estate mantra: location, location, location. Its portfolio of prime, high-traffic retail assets continues to attract shoppers and high-quality tenants, even when the broader economy is uncertain. This isn't a high-growth stock, but it's a reliable income generator. For investors seeking stability and exposure to premium retail, this REIT is delivering exactly what it promises. The hospitality sector presents a complicated picture. Far East Hospitality Trust, FEHT, saw its Q3 gross revenue climb by a healthy 5.7%, yet its net property income actually dipped by 1%. It's a similar story for CDL Hospitality Trust, CDLHT, which reported a 2.5% revenue increase, but a more significant 5.6% fall in net property income, with mixed performance across its different geographical markets. Iggy's take. What we're seeing here is a profit squeeze driven by inflation. Hotels are successfully drawing in more guests and commanding higher room rates, which pushes revenue up. However, rising operating costs, higher wages, energy bills, and maintenance expenses are eating away at those gains before they reach the bottom line. For CDLHT, the mixed results show the recovery isn't the same everywhere. Its Singapore hotels are likely doing better than its UK properties, for example. This is a reminder that in the hospitality sector, you need to look at both revenue growth and cost control. Today's market is a story of divergence. The headline index might be up, but individual stocks are dancing to their own tunes. We're seeing strong operational performance from companies like Keppel, while others, with exposure to tougher markets like China, are struggling. REITs are a mixed bag, with stability in some and pressure in others. The lesson for us retail investors is clear. You have to do your homework. Don't just follow the broad market trends. Dig into each company's results, understand their specific challenges and opportunities. The real wins will come from picking the right companies, not just betting on the market as a whole.